Welcome back to the News Hub here at WSJ Live. I'm Simon Constable. It's deja vu all over again in Silicon Valley as tech valuations go sky high. But as the tech community learned lessons from the painful tech bubble in year 2000, Wall Street Journal's Matt Jarzemski joins us on the set. Thank you for being here, sir.
Yeah, thanks for having me.
Blowing bubbles, frothy, whatever we want to call it, in Silicon Valley. Let's go through some of the things.
Yeah, so, you know, there are just a number of signs that these tech IPOs and tech private company valuations are, you know, maybe not quite at 99 levels, but just, you know, getting overheated. People are starting to you know, really pile into these companies and just really reach for the growth prospects that, you know, sometimes those early stage companies can kind of offer, while, you know, maybe taking the risks associated with that a little bit less seriously.
Yeah, and the risks are very important. Stocks do go down. Let's go through some of these. Twitter actually has revenue. So that's the best of this bunch that we have on the screen here. The rest, Pinterest, Snapchat, Rocket Fuel, all have no revenue. Well, actually, no. Rocket Fuel has some revenue, no profit, but no revenue for Pinterest and Snapchat, right?
Yeah. Well, you know, I mean, the idea with these companies for an investor is, you know, you get in at a very early stage, and if you have confidence that they're going to continue to grow revenue or start producing revenue in some cases, you know, that's where you feel like you can build a model for, you know, when they're going to be a profitable company in the future. Now, in some cases, it's several years out. You know, who knows what's going to happen between now and then? Even something like, you know, the Fed becoming less stimulative, if that kind of dampens overall demand for equities, you know, we could see the valuations of these companies take a big hit.
Yeah, and that's important because the way Silicon Valley works is that the venture capitalists give money, invest money in the startups, and then their exit strategy is to take the companies public. Right. If the demand for new companies in the market goes down, then it sort of feeds all the way back to the startups.
Right. Yeah, and you know, the demand for new companies in the market has certainly been there today, or, you know, this year. We're on pace for the most IPOs since 2007. Some of these tech deals, I mean, not to pick on we mentioned this company Rocket Fuel in the story, but you know, there have been a number of these small, fast-growing tech companies that have come out with really just kind of eye-popping valuations. So
one of the things that is a bit different now than it was back in the run-up to 2000 is that the business model is central to these companies. It's like, okay, how are you eventually going to make money is one of the questions that is instantly asked, and that wasn't really asked in the late 90s. It was just, well, here's how you do it. You get some investors and you sell it to some other investors at a higher valuation, which, you know, the greater fool theory doesn't really work with these companies. Twitter, we know, has a plan, and it seems to be a robust plan. Right.
Yeah, I mean, you're right. That's a big difference between now and then. Also, investors kind of feel like the management teams of these companies are a lot more, you know, seasoned. There's a cybersecurity firm called FireEye, for example, that had a really successful IPO. You know, a big selling point there was their CEO is kind of this tech industry, you know, veteran who's made a lot of money for investors over the years.
Yeah, and we should also look at Facebook, which hired in Sheryl Sandberg.
That's right.
And she's a seasoned veteran. Thank you very much, Matt Jarzemski.